Thank you so much for the introduction. We have a limited amount of time here, so I want to just say up front what I'm going to try to do, and then maybe a second on what I'm not going to try to do to manage expectations. I'm not going to bog you down in too much data. I'm going to try to convince you, perhaps in a very brief period of time, for those that think Europe is uninvestable, which from our work surveying lots of investors around the world, individuals, institutions, and everyone in between, there's a lot of that passion. Europe has inspired since let's say 2010, has inspired a lot of passionate, really, people have become really emotional whenever they think about Europe. And I think a lot of global investors have just decided to stop thinking about Europe completely. You see that in flows where very few people have much exposure to Europe anymore. Anyway, so it's interesting. Prior to 2010, I didn't really see those emotions when it came to talking about the economy, the macro and political situation in Europe. I didn't really see those emotions that often. Since 2010, 11, when the peripheral debt crisis, that was the turning point. Since then, it's remarkable how emotional people get when they think about Europe. There's always a crisis, and it's always intractable, and it's always going to be end of Europe immediately. In fact, all the time. So often, in fact, that it's easy to forget. Right? Meaning something rises up, everybody's absolutely convinced it's going to destroy Europe, and then it tends not to. Actually, never actually has done that. Europe still exists, as we just heard, and then people actually quickly forget what the problem even was. I mean, think about even Brexit. Like why does anybody even talk about Brexit anymore? Which is ongoing, by the way. The adjustments, the trade agreements, everything really started most of that stuff. Of course, the peripheral debt crisis made it seem like the euro wouldn't even exist anymore. Perhaps I'll show you later. The euro has been remarkably stable, actually. So of course, we've had war in Ukraine and Russia ongoing. So there's war, blood in the streets, so to speak, and so many others. There were how many times did we have Italian elections? Okay. Yeah, and everybody was convinced. Everybody was convinced each time that, oh my gosh, the end, right? But by the way, Italy is still very quiet in the last couple of years, had elections, and no one pays attention anymore. French elections, oh my gosh. At times it was, oh my gosh, the French situation is incredible. It goes on and on and on. There's been so many, it's too many to even list. Okay? So what I'm going to try to do very briefly is to show you that maybe it's not uninvestable. I'm not going to try to do any more than that because I don't think you need to. I would actually argue as a second step that once you can accept that it's not uninvestable, the crisis situation is not so bad there, at least versus everywhere else in the world. Maybe everywhere in the world has crises, and we should all move into a bunker and put all our money in canned goods. But if that's not the case, then maybe Europe is not uninvestable. And once you get past that, I would argue don't obsess over the economy too much. Because at the end of the day, I would argue even in the US market, which has been so strong for so long, at the end of the day, when it comes to investing, and I've been at this is my 30th year. I've been at this 30 years investing in Europe. Okay, I've seen a lot. It goes well before the euro even existed. Okay, that's not. At the end of the day, the big returns don't come in Europe from thinking, and I would argue everywhere, but thinking, oh, is the economy really amazing or not? It comes from finding the right investments, the bottom up. Okay, but really, really challenging for anybody to even think about the bottom up if they're convinced it's uninvestable from the macro standpoint. So that's all I'm going to try to do. Maybe it's not uninvestable. Okay, I would argue everywhere has problems. Europe has problems. We can maybe in the Q&A session, I'll try to save time. We'll discuss some of them. I mean, Europe's got plenty of problems. The US, I'd argue, has plenty of problems. Everywhere has problems. So, but if it's not uninvestable, okay, and then I'll try to save a minute or two, even though it's supposed to be on the economy, on the bottom up, because that's where all the magic happens. It's actually where the magic happens. And Europe has been this terrific place, even in the last 10, 15 years of perceived endless one rolling crisis after another. Bottom up has been amazing, and hopefully I'll convince you that. So that's what I'm going to try to do. And like I said, what I'm not going to do is I'm not going to spend a lot of time diving deeply into some very developed economic analysis. There's no time for that. I'm not going to try to convince you Europe is this amazing economy that's booming and all that. I'm not going to try to convince you any of that. Okay, I'm going to try to manage your expectations. Okay, so let's get into it. So okay, here we are.
Yeah, we'll teach them.
I'll teach you. Great. So I'll just draw your attention very quickly. Like I said, we're going to do some quick highlights of geopolitics. I want to highlight a few sort of points on the fiscal and monetary policy, and then get into some equities. Okay. Just first, very broadly, the European economy has actually done fine. I'm not sure people realize that. It's done fine. Okay, hasn't been. I don't know. A lot of people we come across have this impression that the GDP chart of Europe is just this like horrible declining. This is GDP in Europe. It's done fine. Okay. Also, it's a big region, by the way. We're talking about almost 500 million people in the EU. We're talking about quite a substantial population, much larger than the U.S., for example. We're talking about a big economy. It's $25 trillion. This is not a little thing, and it's a rich country. The EU includes countries that aren't rich, so it's a rich country, and the GDP per capita shows that. Okay, let's get into a few of the specifics now. So GDP, it's actually been fine, even if the growth rate has been lower than the US, and I'll come to that in a minute, maybe explaining some of the differences and how much we should care about GDP growth and its significance, and what may be driving it or not driving it. But let's just look at the labor market for a second, because it's very important. So I'm going to sort of break this up, this chart. I have a few charts that I'm going to break into periods, okay? I think there's this perception about the European labor market that it's generally awful. It's inflexible, you can't fire people, it's too expensive, unemployment is so high, and all the rest of it. So a lot of this as a baseline, I'm going to compare the European data to the US, because I think most of us are more familiar with the US, and we're very comfortable with the US economy and investing in its stocks. So if you look here, yes, the European unemployment rate is almost always higher, and that certainly could be, we can now analyze this to death, because some of that inflexibility. Having said that, I would draw your attention to, let's say, the last decade of this chart, okay? Because in the last decade, something has quietly happened in the European labor market. And I can point to a few events that are relevant, but the European labor market, it was always arguably more stable than the US, right? Flexible labor in the US could mean unemployment will surge, you can fire people very quickly every time there's a fear of cars. So maybe it was always more stable. Now it's more stable, but it might also be a little healthier at the same time. I mean, you can use the COVID moment as an example. Look what happened to U.S. unemployment. So this, it's the COVID example that highlights what had quietly been happening at least since 2008. That's why I'll draw like the line at 2008 for a minute. So the European labor market might be sort of more reliable now. And what do I mean by that? In 2008, something quietly happened, drew no attention at all. They created programs in most of the European countries, or many of them, they called them different things, short week and all these other things, where it sort of transformed the European labor market. What that meant was, prior to 2008, whenever there was a crisis, companies in Europe couldn't fire people because it was too expensive. So profit margins collapsed. It was awful. And then eventually they would fire people. And of course, by then things have stabilized, things are recovering, and oh my gosh, hurts on the way down and hurts on the way back up. So they came up with these programs, essentially unemployment programs. So before you start worrying about fears of European socialism and all this other stuff, this program was brilliant. And maybe the US and others should probably adopt some version of it. That said, you can essentially transfer a lot of the burden, the cost of your employees just directly over to the government, while you still maintain at least some relationship with the employee. And when you need them back, or when things have calmed down, and you can just simply take them back onto your payrolls. Okay? And just let that sink in for a second, just how brilliant that is. Versus the US, there was a crisis when COVID hit, massive layoffs. Look at that spike in unemployment. Okay? From a record low to double digits, okay? Overnight almost. And then look what happened. By 2001, because of stimulus and other things, everybody was clamoring to hire people. But if you fire somebody and they're gone, and then a year later, you need them back, you're not going to find those people. You have to go out and hire new people and train them, and very, very hard. It's a lot of friction. And look what happened subsequently, right? Look, wage inflation, all these things have surged. We'll come back to inflation a little bit. All right, so that would be a very big reason. There are many of other reasons, but the unemployment rate in Europe is very low. It actually has come down a lot. It's not in absolute terms as low as the US, okay? But look how much more stable it's been. So in terms of avoiding a crisis in the economy, a very stable labor market, even in tough times and crises, I would argue makes Europe at least not uninvestable, okay, in a very important way. The labor market's become much more stable, even as some programs we could all learn from. Okay, so real quick, some of these issues, and there's plenty of others, like I mentioned, there's always some kind of geopolitical or political crisis in Europe. that everybody's so worried about. Arguably, maybe those fears are subsiding among many global investors. We're not hearing as much panic about them as we used to, but still, we can't ignore them. There's clearly a war still going on. Depending on where you stand on these things, I'm surprised in some level about the controversy here in the U.S. about Russia, Ukraine. That's weird to me. I don't know, maybe some of you have views on that, and we can talk about it here offline. But at the end of the day, in our opinion, with all of the risks associated with that war, keep in mind, we are more than 2 years into it now. This is not a news story, okay? There have been interesting developments on the ground, especially in recent weeks, no question about that. But at the end of the day, this people know about it. People are monitoring it. Yes, the Ukraine looked to be doing has done. We've got to give credit where credit is due. It's done far better than any of us would have expected. I mean, it's almost miraculous what's gone on there. Having said that, no question, there's these debates about funding and all these other things have been problematic in terms of keeping Ukraine competitive in recent weeks and months, and we'll see how that develops. Maybe there'll be progress in DC imminently. But in my opinion, from the U.S. perspective, not to make this political, fantastic value for the U.S. government. Fantastic value. There's really no troop exposure. No, it's the Ukraine who's fighting themselves against an invader. Okay, so we could argue that maybe the U.S. shouldn't be entangled in these things. I get the debate, but at the end of the day, terrific value. And it's Russia has a long history of a lot of positives. I know a lot of Russian people who are brilliant and have done amazing things, and of course, I'm sure we all do. And even Putin, believe it or not, in some ways had a very positive effect on Russia for a long time in terms of restoring their confidence and all that. But his adventurism and his invasion of others, this isn't the first time. That's not even the first time he invaded Ukraine, right? In 2014 he did. So this idea, what's going to happen here? What if Russia wins? That sort of thing. At the end of the day, though, from the economy, from the perspective of the economy, which is the point of this presentation, is not to debate whether Russia will win imminently, whether the Ukraine can win, whether there'll be a negotiated off-ramp. Okay, save that for the generals and for the war room and the war experts. It's to say, from an economic perspective, what are the risks and what are the possibilities? One way or the other, this is hugely stimulative. Okay, and whatever anybody might think about Donald Trump, he was certainly right, and I'm not a big fan of him in a lot of ways, but he was certainly right that European countries have not carried their share of defense spending. They just haven't. And it's absurd. He's certainly right about that. And guess what? Europe got the message. Europe tends to take its time resolving things, unless there's a crisis, and then they resolve them quickly. I'll talk about the energy crisis in a second. But defense spending in Europe is on the rise. We'll come back to whether or not they can afford it and deficits and all the rest of it in a minute. Okay, but the war is highly stimulative. Defense stocks, for example, have been amazing. Take a look at Rheinmetall. Take a look at all of them. Europe has a defense sector that's done great. So from an economic standpoint, regardless of what's happening on the ground and how funding goes, hugely stimulative and probably will be maybe forever now. And don't miss that. Defense spending, in my opinion, even if somebody's is a peace activist, very hard to miss that the countries that have the highest defense spending as a percentage of GDP tend to ultimately end up with a huge tech sector, a lot more innovation. We all know, we were talking about DARPA earlier, right? So it's hugely stimulative right away, spending money directly on defense equipment and supplies and ammunition, all this stuff that's already happening. Even in the last week or two, there have been huge orders out of Germany and all the rest of it. And then in the long run, as Europe spends more and more on defense now, my suspicion is they'll end up with a much bigger tech sector. That's one of the biggest complaints versus the US. The US has a huge tech sector, an amazing tech sector, and Europe has a smaller tech sector. Interesting companies, but smaller. Maybe as a result of this war, in the medium term and long term, Europe will have a bigger tech sector and more innovation. NATO expansion underway already. Sweden, Finland. That's stimulative, no doubt about it. The U.S.-China relationship, tricky, obviously. Europe has been a beneficiary. My guess it'll continue to be so for a long time. We can talk about autos and will Europe try to block cheap Chinese EVs and things. I suspect we'll see headlines there, but they won't block it. If anybody cares about issues like that, because the European consumer benefits greatly from cheap EVs out of China, and they're not going to give that up. And also they have very aggressive CO2 and environmental targets. And the only way to reach them is you got to get EVs in a lot more people's garages. And China willing to subsidize at a loss is one way to do it. So far, you don't have to look any further than the order book of Airbus to see just how big of a beneficiary Europe has been of the US-China tension. Airbus essentially won every China order now for several years. Finally, on the politics, like I said, we went from an endless period of more than a decade, where every political headline in Europe was a reason to panic. Whether it was an Italian election, whether it was a French one, whether it was Brexit, whether it was an outcome even in Eastern Europe, whatever it was a reason to panic. Now, most elections have been coming and going, and people haven't even noticed. I will point out, though, from an economic perspective and ultimately a markets one, politics in Europe has quietly shifted quite a bit right. Okay, maybe it's in response to immigration, maybe it's in response to complacency for too long on Russia, whatever it may be. Politics in Europe has moved pretty far to the right, and we could talk about whether people care about that or not. But at the end of the day, probably better for the economy, certainly better for the markets. Look at Italy. The Italian market has done very well since a right of center election. So again, politics very quietly shifting right, properly market friendly. And finally, all the Euroscepticism seems to have faded away. So maybe people are catching on. I just think people aren't talking about it as much. I think there's skepticism when they do think about it. They're just not thinking about it very much. But it's totally misplaced. So either it's faded away because nobody cares, or it's faded away because people understand just how stable the euro has been. We'll come out that in a minute. So take a look at this chart. All right. So the euro has been like the Rock of Gibraltar stable. And I'm not sure anybody or that many people in the global investor realize that we do have a currency expert in-house, but I'm shocked how stable it's been over time. It came into existence January 1, 1999, after great fanfare. It actually weakened in its first couple of years of existence. It then rallied back when Europe had a booming economic period in the early 2000s. And even through the peripheral debt crisis. Look at that chart. Trying to get rid of some of this stuff. I'm carrying on, but take a look, like versus the end, other things like it's really stable. And take a look. It came into existence on 118 or so, give or take. Okay, it dipped down below parity for a couple of years, and then rose back up above parity for a couple of years. The low in the peripheral debt crisis, when everybody was convinced, or so many investors were convinced the euro would go away. The trough in the peripheral debt crisis was 118, 119 even. Think about that. In the depths of the peripheral debt crisis, when it looked like Greece and the whole periphery was going to bring the euro down, the low of that period was actually the level it started at. Okay, and then yes, it dipped a little bit lower in subsequent years in negative interest rates. People played the carry trade and other things, and then it came back a bit, and it's 107 or so today. Okay, very competitive rate for Europe. Certainly, a very strong euro may look good to some people in terms of the economy, but it makes the corporate sector and the bottom up, so to speak, less competitive. So I would just point that out, that through the peripheral debt crisis, the global financial crisis, war, elections, all the rest of it, euro actually has been really, really stable, and I'm not sure people are. Okay, maybe now we'll talk a little bit about deficits. Okay, so this perception among many we've come across, and maybe some of the people in the room, maybe most of the people in the room, that the US is this economic growth machine, and Europe is old Europe. Old Europe doesn't grow. All right, why bother? All right, and you could be forgiven on some level for thinking that, because the US GDP growth rate since 2008 has been quite a bit higher than the European growth rate. Okay, it wasn't always the case. Europe had booming periods, but since 2008, that's been the case very consistently. I would argue, though, it's not what it seems. Okay, and actually what happened after 2008, especially after the peripheral debt crisis, was Europe entered a long 15-year period of austerity. And the US entered a long 15-year period of deficit spending like crazy. Mm-hmm. All right, I'm assuming many of us are US taxpayers, if not most of us. Maybe we should, I'm sure we're paying attention to it, but it's been extraordinary that Europe entered into a long period of austerity, and the US decided to spend like crazy. All right. So what does it mean? All right. If you look at the cumulative difference in deficits between Europe and the US, and the cumulative difference in GDP growth, which this chart shows, I know it looks a little confusing at first, but essentially the US has spent 50 percentage points of GDP on deficits, okay, since '08, more than Europe has. Europe has run essentially a small deficit in each of those years as a percentage of GDP, and the US has run a very large one every single year now, okay? So the US has spent 50 percentage points of GDP more than Europe on deficits to get 38 percentage points more of growth. That chart is scary. I think it confirms what a lot of us may think from our old economic stuff, for those of us who ever looked at it, that government spending, it might be necessary, but you shouldn't expect a huge positive multiplier from it. Okay, the government is typically not trying to make profits and trying to be the most innovative and highest returns and all that. Like we said, in the DARPA funding, they're giving the grant. They're not even looking for equity, right? So their goals aren't to maximize returns on what they spend. It's to achieve certain important structural goals. So maybe it shouldn't be a surprise that deficit spending, you should want it to be the necessary types that make a real difference in providing stability and other things. And you shouldn't want any more government spending than that, in my opinion, because you don't get a huge multiplier. It's not a great thing for the economy past the point. All right, and I think this shows that. So yes, European GDP has grown more slowly, but deficit spending explains an awful lot of it. Okay, so let me now take this a step further. All right, again, another example of the chart. I'm going to break into a couple different periods here. All right, so if you go and you look historically at deficits, they were kind of not so different between Europe and the U.S. Maybe Europe ran a slightly larger one. It was more or less in the ballpark. Then you entered a period since '08 where, yes, Europe had slightly higher deficits. Overall, Europe was never in really that much fiscal danger. You had the periphery that had much higher debt to GDP and higher deficits to GDP prior to '08 and prior to 2010 and 13. Okay, so let's just break this down. Prior to the peripheral debt crisis, Europe had higher deficits and generally overall debt to GDP, not a particularly concerning number. Okay, in the kind of the 70s and 80s% in that period, higher than the US though, which was in the 60s. Coming into '08, US debt to GDP was maybe 25 points lower, right? So coming into the peripheral debt crisis, not crazy numbers in terms of debt, but Europe did have higher debt to GDP, and they did have higher deficits every year. They were spending, especially in the periphery, more than they should have probably. Peripheral debt crisis hits, massive loss of confidence, of course. Most of us will remember that. And then Europe decided to find religion and enter into aggressive austerity, aggressive. So look at that blue line. All right, as a result of the fiscal crisis from 2010 to 2013, EU deficits actually rolled down, actually rolled over as US deficits took off. And now we're in a period, okay, where debt to GDP in the EU is considerably lower than the US. Since '08 or since, let's say, 13, when that kind of peaked out, EU debt to GDP has come down, okay, even with a slower GDP growth rate. All right, whereas in the US, even with a higher GDP growth rate, debt to GDP has exploded. So we're in a situation now, there was this number, 90%, if anybody remembers that famous economic paper that created so much controversy and turned out to be errors in Excel spreadsheets and things. But people became convinced that 90% was kind of the magical debt to GDP number. It turns out, it doesn't matter at all. If anybody looks at places like Japan, which has been literally 2 or 3 times, so more than twice that, maybe it doesn't matter. Having said that, I don't think people realize that debt to GDP in the EU is considerably lower.
Doing a 603rd.
I mean, you.
Somebody might have come off mute. Anyway, so I just want to highlight that in terms of thinking, not that the EU Europe is some amazing economy, but just so maybe it's not uninvestable because deficits and debt are out of control. It's actually not true. They spent a very quiet 10, 15 years bringing deficits down, actually down, while the US deficits have exploded to a point where debt to GDP is quite a bit higher now in the US versus Europe. But let's talk about inflation for a second. So again, another chart that needs to be broken into time periods. That blue line for most of that chart was going down and down and down. Okay, and as we all sit here in the US hoping inflation comes down so the Fed can cut rates and all the rest of it, Europe came from the opposite problem in recent years. They came from teetering on the precipice of deflation. Okay, and the big fear among investors and why they started disliking Europe so much was, oh no, they're going to get mired and caught up in deflation. The next Japan's you're going to lose 30 years, whatever. So look what's quietly happened. Okay, inflation rose. Okay, deflation fears are gone, at least for the foreseeable future. And then something very magical happened in the very end of that chart. Inflation rolled back, and these are inflation expectations, 5-year, 5-year, rolled back down to kind of Goldilocks, right? I think in when you look at the Fed or BCD, they kind of want 2%, give or take, is kind of the magical number. Major central banks in the Western world kind of want. Inflation expectations in the US have not come down. Inflation's come down in the US from the very high levels. Everybody saw the CPI print a week ago. It wasn't low enough, and people are nervous that maybe inflation is going to be stubbornly high, and Powell's come out and said maybe we can't cut rates as much as we thought. Okay, fine. And the stock market's down a fair amount this month in the US, less in Europe. But take a look at that chart. Inflation expectations actually have rolled over in Europe. Not to the point where, oh no, we're back to deflation somewhere, but actually back to Goldilocks, and it's been holding pretty steady there in the last couple of months. Again, maybe too soon to call victory on deflation and inflation in Europe, but certainly showing the signs of victory over deflation. Dead, done and dusted that topic for the time being, at least, maybe forever, or for a very long time. And maybe, just maybe, there's more credibility that the inflation risk in Europe is actually under control as well, and maybe the ECB will be cutting rates a little more easily than the US can, and you have a much more dovish monetary policy in Europe. Not one that's fearful of inflation, other things that maybe you need to be worried about, but one that's actually healthy because inflation's in a good place. So again, not trying to convince you Europe is the best place on earth, but from a topic that I think a lot of us are concerned about in the US, used to be concerned in Europe, used to be concerned about deflation and then concerned about inflation. Actually, maybe Europe is the region that's really in the sweet spot. I didn't put Japan on there. Maybe I should have, because Japan is, in my opinion at least, and there are others in the room that could speak more eloquently. But if anybody's behind the curve on inflation, it's probably Japan. They're going to try to catch up here by tightening monetary policy. But inflation is, again, from deflation, they've moved into an inflationary period much higher than their targets were, at least. They don't keep moving their targets. And now they're going to fight it. So monetary policy in Japan is getting tighter and tighter, but coming from an extreme point of being easy. In the US, stubborn inflation expectations are not budging yet. Not a great situation. Whereas Europe, maybe, just maybe, we're kind of in a Goldilocks situation on inflation in Europe, and I don't know if anybody's paying attention to that. Okay, an extension of that, let's look at the bond markets for a second, and interest rates.
We have about 10, 15 minutes left.
Okay, I'll move a little faster.
We can get some Q&A, and that'd be great.
Okay, thanks, Mark. So again, let's talk about the bond markets for a second as an extension of monetary policy, inflation, et cetera. The interest rate situation in Europe looks great right now. Okay, and again, here too, you came from a point of negative interest rates. And I really started to fear, especially when COVID hit, that's it. How can Europe ever get out of negative rates again? I wasn't sure there was going to be a way. That once you're into negative rates, and the Fed never went negative for this fear, I think they specifically didn't go negative for fear that you'll never be able to get out. Okay, and Europe got out. Europe got out, and that has real implications in my opinion, for the health and outlook for the European economy. Europe got out of negative rates. Interest rates have come up to a healthy level. They've stabilized at a level that's still great, easy money. You're not going to find really any large European corporate that wants to borrow money complaining about these rates. These are still great rates, and it's coming from a point where it's healthy. When rates were negative, and maybe European companies should have been borrowing more, and they weren't actually, because they were fearful of deflation and what negative rates can mean, and maybe they should be fearful of it, right? Obviously, it's all else being equal, it's cheaper to borrow at a negative rate than a positive rate, but they weren't borrowing for the fear of what negative rates might mean. And now you're kind of at a point where a lot of those fears have been addressed, and interest rates are still very low. And now, as an extension of that, okay, interest rates went from negative to positive, And that, among other things, might have solved one of the biggest problems for the European stock market. Okay, so the European stock market, of course, we can talk about in a minute, obviously has underperformed for anybody who's looked very, very dramatically versus the US market. Like I said, at the bottom up at the stock level, which I'll come to and spend the last few minutes on in a second, it's been a magical place. And we could talk about examples of that and all this other stuff. But that's bottom up. That requires a lot of work. That's what we consider our specialty. But the bank stocks have been absolutely decimated in Europe since '08. Okay, coming into the 2008 global financial crisis, the European bank sector was by far the largest percentage of market capitalization in Europe. Okay, think about that. Largest sector by far was Europe, were banks in Europe. And then you came into a global financial crisis, which crushed the banks, and then a peripheral crisis, debt crisis in Southern Europe that crushed them even more. So the overall market indexes in Europe that have underperformed so much, those initial years, the first, 08 through, let's say, 13, was really driven so much by banks. Okay, and the crises associated with that were resolved. So where are banks now? Right, because without a healthy banking sector, very hard to argue the European economy is okay. All right, so let me show something. You can't see it on this chart yet. Like I said, it has to be broken out, which I'll do for you. But let's look. So you had European banks and US banks that looked the same for the first half of that chart. And then you had the '08 crisis where they crashed, actually a similar amount, maybe even not as much as the US banks did. And then as the US banks started to recover, look what happened to European banks. Rolled back over in the peripheral debt crisis, 2010 to 13, and then actually went down a lot further over the subsequent decade as US banks did really, really well. Okay, so where are we now? Let's now look at the last period. Okay, so this is since essentially the low in interest rates. All right, European banks have outperformed US banks by quite a lot. Very, very, very strong European bank sector. What is happening? And by the way, that European bank sector is dominated by JP Morgan and other banks that actually have done well. All right, and still, European banks have raged in the last couple of years. What's happening? All right, so point number one is the move from negative to positive rates. Okay, has been terrific for European banks, completely restoring capital ratios, balance sheet strength, all the rest of it. Right, so from the peripheral debt crisis until the increase in interest rates in the last year and a half or so, okay, the European regulators, right, the ECB took over as the bank regulator. After the peripheral debt crisis, the ECB, the European Central Bank, took over as the bank regulator, okay, and really wanted to be a credible regulator and beat the heck out of the European banks for a decade, forcing capital ratios up, forcing all kinds of, essentially forcing them out of entire businesses. The European banks largely gave up investment banking to the US banks. Okay, so US banks were doing very well, okay, through that decade. European banks were doing very poorly, tough regulator, having to lose market share, all these riskier assets, et cetera. What's been going on since? So now European banks are much more so in the regular business of banking. Okay, essentially, getting some funding from various sources, deposits and other things, and lending it out, mortgages, and it's kind of the basic business of banking, much lower risk kind of businesses. The move from the low in interest rates has been a big burden, as many of us will have followed, for US banks, crushing the regionals and community banks to the point of crisis, right? Because the increase in rates caught them off guard with the asset and liability mismatch. There are banks, right? Banks have a natural asset and liability mismatch. They borrow short and lend long, right? That's their business, is an asset liability mismatch, right? So if you're borrowing short and lending long, and then your short-term interest rates rise a lot, and your long-term interest rates, where most of your assets are, don't, damn well better have hedged very, very well, and you understand all of that, okay? But certain accounting policies that didn't require mark-to-market, blah, blah, blah. Okay, all these things. So the rise in interest rates in the US has been a burden for the banks to the point of failures, large failures. The rise in interest rates in Europe from negative to positive has been a big positive. It's the first time in my career, 30 years, where the US and European banks aren't moving in the same direction. Fundamentally, are not moving in the same direction. Usually they move in the same direction, and some do better and some do worse. Actually going the opposite direction. From negative to positive. For example, in the US, the move from low interest rates to positive rates saw a deposit flight, because there's something called deposit beta. So as short-term interest rates rise, banks don't pay us depositors, right, that full increase right away. They try to drag their feet to keep their funding cheaper. right? So assets reprice and loans are given out at higher rates, but they don't raise your, I don't know if anybody has money at JP Morgan right now, they're probably paying you nothing right now, even with interest rates having gone up so much. All right, so they try to lag that to try to get going. But people aren't stupid. So a lot of people take their money out of the bank and they put it in things like money markets, which have much higher returns, right? Much higher yields right now, right? So whereas in Europe, it went the other way. When rates were negative, everybody took their money out of the bank. You realize if you left your deposits in a European bank for years and years, every month you get a statement and your balance would go down. Rates were negative. So everybody took their money out. They weren't even keeping working capital in the banks anymore. When rates went back positive, people put money back in. Deposits went into European banks in this rise in interest rates. Actually the opposite. Okay, so European banks, very, very healthy. Certainly not a reason for, I'm not saying you should pour all your money into European banks if you do a lot of analysis there. And also, we can talk about real estate and maybe the rise in interest rates will still feed in slowly to loan losses and things. We can talk about all that stuff. So this isn't a comment about being bullish on European banks. The point is a lot of investors we've come across have thought Europe is uninvestable and the economy's in trouble because you need a healthy banking sector. They don't have one, but they do.
I'm not sure that's a central thesis of our group. I think our group is not whether or not the economy is healthy, but where are the opportunities?
Great. But thanks so much for that question.
Why don't we
Thanks for
separate it?
kicking me. Thanks for kicking me in the butt because I'm running out of time.
Well
So
said.
let's just get into it. Investment opportunity. Can you imagine? So okay, like I said, all these kind of top-down opportunities. Now let's just get into, in the interest of time, at the opportunity. So forever, Europe and the US used to kind of dance around each other in terms of stock market performance. Okay, and international diversification was a magical thing. The late great John Templeton, I think, convinced a lot of US institutions of that said at the end of the day, you're probably going to get to the same place, but at different times. So if you have international diversification, okay, it's going to be good for performance and you're going to reduce your risk in the meantime by having that diversification. It's an no-brainer. Okay, and that happened forever. I can go back much further. This is since 1970. And then came 08, and look at that chart since. Marty said sometimes we could be early in things. We're certainly not late. Okay, and thinking that maybe Europe is not uninvestable. The European stock market has been absolutely atrocious compared to the US stock market. All right, very out of order. Like I said, it used to be 10 years where Europe would outperform, 10 years where the US would outperform, and they just kind of danced around each other forever. And then all of a sudden, in the last 15 or so years, one-way train. Okay, and we've discussed a lot of reasons why. I've tried to suggest maybe some of those reasons are changing. Okay, and then I'm going to conclude with one very important disclaimer about it all. I don't think it matters all that much. Like I said at the beginning, you just have to think Europe is not uninvestable. The economy is not so horrible that it's uninvestable. Because at the end of the day, GDP, economic performance, and the stock market, I'm going to argue, happy to talk about it more in Q&A, happy to go right offline, doesn't matter that much and might not matter at all. And let me use China as the great example. Okay, Chinese GDP in the last 30 years is up, I think, 30-fold. Chinese GDP in the last 30 years is up something like 30 times. Anybody know how the Chinese stock market has done in the last 30 years? No. MSCI China, because that's an index that's been around for 30 years, is down. The MSCI China index in the last 30 years, 2024, is down, even with GDP going up 30x. Okay, so maybe that's a good example that the stock market and GDP, they're not as linked as a lot of investors think. All I'm trying to say is I respect the notion that if there really is a crisis in the economy, maybe you shouldn't be investing in the region until the crisis is over. So all my goal is to say there's no economic crisis in Europe. There are a lot of things going on. There are a lot of things going on in the US market. Maybe it's not still uninvestable. And once you get past that, then you got to get in the bottom up. And that's where it's just magical. Like I didn't put Novo Nordisk on this chart. Obviously Novo Nordisk, which is the leader in obesity drugs, which are exploding right now. I'd be shocked if there's no one in the room using them. These are magical drugs. I think so many people, obviously very important for the health sector. If somebody wants to lose 5 pounds, please don't use this drug. Please don't, because the truth is you need to be on it, like maybe forever, for your whole life. All right, so if you want to lose 5 or 10 pounds, don't get on a drug that in order to keep the 5 or 10 pounds off, you not your whole life. All right, that's not a good idea, even if so far all the safety data looks
That's
great.
easy for skinny guys.
No. Let me tell you the second half of my statement, very important. I'm saying if you only need to lose 5 or 10 pounds, if you need to lose more and you meet the technical definition of obesity, which is not nearly as onerous a definition as people might think, these drugs are magical. So these aren't new compounds. They've been around for a long time. There's a lot of safety data. It's really, really something. These are wonder drugs. There's already large-scale safety data on heart. These drugs aren't just about diabetes. They're originally for diabetes, right? Novo Nordisk was a monster of a stock my whole career on diabetes. Obesity is a new thing for them. They just happen to realize that one of their obesity drugs has this remarkable effect on obesity.
And sleep apnea.
Wait for it. How about inflammation? We can go into heart. We can go into sleep. We can go into all these areas. Inflammation, which is the broadest possible category you can probably talk about. It might actually help in inflammation, which is kind of like everything that bothers people. Right. So again, I don't want to overstate the case. We're going to do a lot more studies over time. These are wonder drugs. Obviously, the U.S. has Lilly, also in this space. It's a two-horse race for now. There are some others nipping at the heels of some products we'll see. But Novo Nordisk is a European company, and it's been a juggernaut. How about LVMH? Bernard Arnault, richest man in the world. Richest man in the world. I bet most people in the United States hadn't even heard his name until relatively recently. And he's the richest man in the world for good reason. You know, luxury goods. It's a sector the U.S. doesn't even have. The U.S. has big tech. Used to be called FANG, and then Faminaming, and all those other acronyms, and now it's Magnificent Seven, but maybe Magnificent Six if you can speak. Okay, the U.S. has a wonderful tech sector, no doubt. But Europe has some wonderful things too. All right, luxury goods would be one. Okay, another infrastructure. Europe has a huge infrastructure, tremendous opportunities in that sector. The U.S. has little or none of that. Toll roads, airports, this kind of stuff. There are a lot of large and very, very well-run European companies that own airports and toll roads around the world. Yes, please.
Just on the comparison of US banks and European banks, I don't know the European banking sector that well, but does that include trading bank? Those stocks?
It does not. It does not. They're just the bank. I believe we use the BKX. I think we use
Yeah, I have to wonder when you're comparing the banking sector, if you're including, I guess, regional banks. I'm not sure if Europe has as many banks. How many banks does Europe have?
So European banks are much more consolidated.
Right.
The U.S. still, even after the failures and crazy consolidation. I mean, J.P. Morgan Chase itself. Think about how many banks rolled up in 61 days. So even after tremendous consolidation, there are still thousands of banks in the United States.
4,000 banks.
Yeah. So no, Europe, you're talking about hundreds. So it's a much more consolidated sector. That's why it was the largest percentage of European market cap coming into 08, because they were much more consolidated, they were much more market share. So in terms of comparisons, you know, at the end of the day, they're both market cap weighted indices. So the large cap banks will dominate those indices, even if we can get into the minutiae of the tail, right? Yes, the BKX has some of the regionals in it, but you're already talking about small market caps. And by the way, some of the large US banks have actually performed well. So to see the US banking index still do so poorly compared to Europe, even with a market cap weighted index where the large guys have actually done fine, I think says just how much stress the US banking sector is.
Oh, regional banks are in a lot of trouble because of the real estate loans. So do you have a sample trade that you've done that's meaningful right now that the group can look at?
Yeah, I mean, yes, thank you for asking that. Also, there are a number of names even on this list right here. For those that can see the slides, I hope everyone who's zoomed in can. You know, Airbus would be an example of a stock that's still, amazingly, after everything that's happened in the last few years, still a stock that's much cheaper than Boeing. Wow, that's amazing.
You think it's undervalued?
I think it's still undervalued. Okay. Yes, it's been a good stock, but it's one of those kind of generational ones to own probably. Air Liquide, I'd also highlight. The industrial gas sector is a terrific industry. It's consolidated like you wouldn't believe. There are three major players, and one of the three air products in the U.S. is distracted by futuristic green hydrogen stuff and whatever, and it's kind of distracted from the core business of industrial gas. Linde Group, which is technically a European company, but U.S. listed. It's European listed as well, but that's been great, but that's been re-rated very dramatically. That's I would argue great company still, but maybe not attractively valued. Quite the same as Air Liquide. Air Liquide. So Linde Group is the largest industrial gas company in the world. Okay, Air Liquide is number 2, and Air Products number 3. Between the three of them, they have north of almost 75% of the global market. Think about that.
Is your strategy long only, or do you hedge it, or?
We pride ourselves on short selling as well. I don't like to talk about it because it's a controversial subject to many investors.
Why do you say that?
It's not controversial to us.
I love that. I love that. You know, I'm just meeting almost all of you.
As a trader, I mean, that's a big part of trading is being short.
When you just see
And something like Boeing is a company definitely. What's going on now is you want to be short. A lot of times with all the negative news that's come out, and
And every time he lifts his head up, he just gets slammed again and again and again.
Oh, please, we don't have time. Marty's gonna kill me. I think I'm already over time and I started a few minutes later than maybe original, but please, let's
You're
talk
over
about
time,
short
I
selling.
need more time, don't worry about it.
I got to say something. We can talk to you about short selling. We have a lot, very few people in this world anymore, investors, still sell short individual stocks. Very few. Some of the greatest of all time went out of business a long time ago. You know, even Jim Chanos, you know, one of the more famous short sellers of all time, if you actually look at his most successful track record, it's a very net long product. I don't know if some of you may know that better than I do, but meaning he's long S&P futures in 200% and has his shorts of 100%. He's a very, very net long product. And that track record is amazing because he added alpha on the short side, but most of those returns came from the long side. So shorting is a very hard thing to do. We pride ourselves on it. We have generated positive returns shorting. We have generated huge alpha from short selling in Europe. There's a reason for that. Investing in large European companies, very different from the US. All right, I can take this offline in the interest of time, but just let me give you 1 second on it. In the US, the stock market, the beta has been amazing. Oh, especially if you've kind of been a tech investor or a closet tech investor. Okay, so the beta of the US stock market, oh, amazing. Go up on the S&P, goes up and up. And you see what time people wake up to it. Look at the passive indices dominate what people do now in the US. In Europe, invest passive in Europe, it's terrible. I showed you that the indices have been terrible in Europe. If you invest passively into an ETF or index fund or something, you've done terribly in Europe. Okay, but the bottom up to it all in Europe has been amazing. How is that possible? Because in the US, whether people realize it or not, in my opinion, you are trying to figure out bottom up if Microsoft is going to beat or miss earnings by a penny. You can think you're not playing that game, but you can be run over by it. Okay, if somebody comes up a penny or two short, you know, you're going to be run over by it, and then you got to figure it out, and it can be hard. Right? In Europe, there's no such thing. Nobody gives EPS and revenue guidance for the upcoming quarter or year. It doesn't exist in Europe. But the whole thing doesn't exist in Europe. You could do bottom-up fundamental research, understanding your companies and your industries, and you could add an enormous amount of value, alpha. Whereas in the US, even the funds that have done really well, a lot of it has essentially been the tech. Maybe they got tech right or not. That might be the biggest factor of whether you've performed well. And then it's been beta after that. So alpha generation among US, even great investors, alpha generation has been really elusive for a long time. Because at the end of the day, you got to figure out all these companies are so good at managing expectations down to the penny. And you got to add value in that or get run over by it.
So what are your long short ratios?
So we've always kind of done two things. So I used to be focused much more on outside investors. In recent years, most of our money is my own and a few that co-invest with us. A few family offices and a few wealth investors. That's how we ended up coming across you guys. We're mostly a family office now, pretty much that's what we do.
So you need to move away from the camera.
So I have what might look like a more traditional long-short strategy, okay, that runs 50% net without really much variation. Okay.
Is there any leverage involved?
No. Okay. We use the balance sheet a little bit, but it's 50% net. So at the end of the day, you have to take risk. If you don't take risk, you're not generating a return. But we try to understand the risks we take. And leverage, if you look at the successful investors, hedge funds in particular, which I ran for so many years, decades, when you look at the ones that use leverage as one of the risks they take, there tends to be something about them. Of course, there are a lot of funds that use leverage, maybe looked smart for a year or two even, and then blew up. But let's look at the ones that have survived with good track records for a long period of time using leverage. They tend to have a giant number of employees. If you look at the multi-manager platform funds, the Millennium, Citadel, these guys, they have thousands of employees, thousands. Okay, wow, that's crazy. So leverage is a dangerous thing. People should be careful of it. Maybe some prudent leverage in certain asset classes, I think is certainly great. Too much leverage, risky thing.
And you're only doing large caps?
We just do large caps. Small caps are very sexy to talk about. And in the US, probably much more practical to invest in because even small caps in the US are very liquid. In Europe, small caps, even mid caps, they're really illiquid. You can always get in, but you can't get out if something ever happens. But large caps, liquid, there's 500 or more of them. They touch everything in the world, every industry, every country, every concept, every theme. It's a great universe, and it's a manageable universe.
So something people don't really talk about in the United States, but and people are in the know, it's well known, is that the Magnificent Seven do lots of mergers and acquisitions. You look at Google, Facebook, they've acquired 200 companies each the last 20 years. What's the profile for that kind of activity in Europe?
So bankers love Europe. Okay, investment bankers love Europe. The notion of building up and then taking apart, and then building up and then taking apart. I mean, Europe is a sweet spot for that. Early in my career, so many of the large cap companies in Europe are conglomerates. I mentioned some of these, Linde, which is more or less a pure play industrial gas company right now. I don't even remember all the things they did at the beginning of my career. I've lost track. They did so many things, right? So Siemens, Alstom, there's so many of these big companies that did so many things. And then the investment bankers got a hold of them, and the investors got a hold of them, and shareholders got a hold of them, and convinced them to break up, and that released a lot of value in many cases. And then you have big M&A waves where they acquire lots of things, and then they
So what's that look like today, though?
Today, the M&A landscape looks great. In the last few weeks alone, we've actually seen quite a bit of deal flow. There's a paper company, DS Smith in the UK that actually got a little bit of a bidding war. It looks like International Papers won it, but Mondi started the bidding process. So like I said, European companies probably should have been doing more. They like M&A. European companies love M&A. So if you have a good M&A department, please make sure they're all over Europe. So they love M&A. They were scared of it during the peripheral debt crisis, and really in the decade after, and when interest rates were negative, where they could have funded. You don't know how many presentations we gave companies in Europe. We gave presentations to companies pointing out that a share buyback when interest rates are negative, okay, and for the corporate sector, that meant the average large cap non-financial in Europe 3 years ago, could sell 10-year corporate bonds. This is a broad average with a lot of differentiation for about 1%. Okay, and the average dividend yield of that same group of companies is maybe 4.5%. So the savings on the dividend per share for every share you buy back was a multiple of the interest expense you had on the bonds. Okay, and you could have sold perpetual debt. A lot of the large cap companies could have sold perpetual debt. Never need to pay them back for maybe 3%, 3.5%. Again, a savings over the dividend, right? And that's perpetual. You never even pay that back. Okay, so share buybacks in the U.S., which have been obviously huge support for the market, giant buybacks in the U.S., crazy even at times. You have to buy into how it's long-term accretive to earnings and returns. It's not instantly just free money, right? You have to buy into the growth and safety of the company in the future and all that. In Europe, you didn't have to do that. It was instantly cash accretive, instantly and forever, right? So and still we only convinced a handful of companies to do it at that time because they were great. Now share buybacks have surged, huge amounts of share buybacks. M&A is very healthy in Europe right now.
You spoke about conglomerates. I guess there's a lot of privately owned conglomerates as well.
Yes.
Do you anticipate any of those going public or being acquired in the near future, or?
Both probably. I would say more will be on the M&A side. The capital markets in Europe are healthy and functioning much more than I think people generally realize. But the IPO market in Europe has some structural disadvantages, in my opinion, which is why you don't see a healthier IPO market. One of them, which the bankers will say is a positive, okay, but I say is a negative, and I think I've won out on this argument now with decades of evidence, that most European stock exchanges and marketplaces have minimum free float requirements because you don't have an equity culture in most. You have an equity culture in Sweden and elsewhere, but most of Europe doesn't have an equity culture. So if you IPO and you do the 10 to 15% of your stock you put on the market, like the US IPO market tends to do, they're not going to trade. Their shares aren't going to trade. You don't have a huge equity culture. So they require often 25% or more.
So there's a strong contingent of our group who's like, pro Poland. Any thoughts on Poland?
It's interesting. We don't invest directly in Polish stocks because it falls into the emerging market category. And the reason I stay away from that, it's not some mandate thing. I'll invest whatever the heck I want. It's that at the end of the day, as I said earlier, I want to invest in places where the macro, it's important, right? It's not unimportant anywhere. It's not unimportant in the US. But once you get past that there's no economic crisis, you're free to do your work at the companies. And in emerging markets, in my opinion, you're not free to do that. The macro is so important in emerging markets that you invest in companies at your peril sometimes. Because
I think Poland's already the second largest manufacturer in Europe.
Yeah, it has to be manufacturing based, but a lot of emerging markets do, right? Mexico has a huge manufacturing base and all that. But at the end of the day, if you get an inflation print wrong, even in Poland still, Poland's come a long way. So we like Poland. We actually like Poland economically. We like Poland. Another example of places that move to the right, all these other things, and has generally been responding well to that in terms of the economy and markets. But at the end of the day, the macro is a little sort of too influential for us to invest directly. But we certainly have a lot of companies that manufacture in Poland or that have operations in Poland. I mentioned toll roads, and probably some of these companies have big businesses there. So Poland is a great example. Also, we mentioned the Russia-Ukraine conflict. Poland is a very important player in all of that in terms of convincing Europe what to do and how to do it. So Poland's important.
Just some light on your views on ECB's balance sheet side and in terms of your outlook on as inflation's going on.
Yeah.
Can you repeat the question?
Yeah.
So I was asking about ECB's balance sheet.
Yeah. So central bank balance sheets. Again, I'm not an economist or an expert, but I'll share with you my view since you asked. The central bank balance sheets have absolutely exploded far more than maybe any of us would have possibly ever expected 15 years ago. Okay, the ECB and the Fed balance sheet, believe it or not, as it exploded through the global financial crisis and then through COVID, believe it or not, they kind of ended up in roughly the same place. Whatever I don't remember, it was 8 or 9 trillion or something that they peaked out at roughly, both of them. That's weird. What a coincidence, right? So you're talking about kind of a similar order of magnitude in terms of size. And these are really, really scary sizes. You know, these are numbers, I mean, $8-9 trillion. Jeez. Having said that, in one way, I would say the ECB balance sheet is a little more supportive of the economy and markets these days because there's not QT in this aggressive way as it is in the US. It's more of they're trying to peak it out and manage it here, and everything is kind of quiet and calm. The US has been pursuing, as many of us will know, a fairly aggressive quantitative tightening policy. Year over year, I think the Fed balance sheet is down now about 1.1 trillion in the last 12 months, even more than that from the peak. So with a lot of volatility. Okay, and maybe the volatility is to the Fed's credit, because when the regional bank crisis hit, at that point from the peak, the Fed balance sheet come down, I think about $400 billion, something like that. You probably know the numbers better than I do. And then the regional bank crisis hit, and almost overnight, over the next few weeks and months, the Fed balance, the Fed balance sheet went all the way back up to the top. Hundreds of billions they shoved into the economy, they shoved into the balance sheet of stimulus overnight when the regional bank crisis hit last year. But all the while, the QT program of selling bonds and letting bonds roll off continued. So once they injected all that aid and stimulus into the economy overnight, it then rolled back down. So I'll give the Fed credit for responding to the regional bank crisis faster than I've ever seen a central bank respond to anything. Okay, that is a huge positive. In Europe as well, by the way. I mean, the Bank of England, very quietly, there was a pension crisis in September of 2022, if anybody remembers it. And the Bank of England went on a Monday from saying we are as hawkish as we've ever been, okay, to restarting QE on Thursday. Monday, super hawkish. Thursday, restarted QE for several weeks because of pension. So I will give central banks credit for being more responsive to issues and therefore probably making the investing landscape much healthier and much safer than maybe the credit one.
We've got time for one more question, Brian.
Oh, great. I think PE and VC are alive and well in EU as is research. So how much of a lift do you think there might be in a war footing, security, border security in the economies there? I mean, after all, PE, VC are job creators. They increase GDP per capita. Is that a hopeful sign in Europe?
Yeah, I mean, we mentioned defense earlier, so you're going to see a huge amount of spending there, and there's going to be a lot of VC and PE activity there, I'm sure. VC for sure, you're going to see that. Raise defense budgets, very multiples of what they were. And
there's also more Europe-US cooperation, I think, than ever before.
Yeah, I would suspect that. We'll see if a Trump victory occurs, what that does in terms of sending, but generally speaking, more cooperation, I suspect, is probably in the cards.
Yeah,
Trump likes to say otherwise. And he wins, a lot of good stuff. So in terms of PE broadly, PE is very alive and well in Europe. What you don't see is a lot of headline grabbing take privates from PE firms. Okay, not nearly as often as you would even in the US. So you don't see that. It's much more under the surface. You know, PE firms buying divisions of companies,
Right.
either taking from privately held families, a huge, as Marty pointed out earlier, huge family-owned, the Mittelstand in Germany, there's huge names for these giant amount of family-owned businesses and things that maybe the older generation is passing to the younger generation. You're going to see a ton of activity on that front, but it's not as attention grabbing. The reason, in my opinion, without going off on a tangent, why you don't see more take privates, listed companies being acquired by private equity, because private equity firms are giant, they should be doing that. And in the cycle that ended in 2008, there was a lot more of that. We've spoken to private equity giants about that, and they say things like, the second you approach a company, it's going to leak, it's going to be in the press. Okay, and PE firms sometimes are looked at as a bad word in Europe, and you're going to have the stocks shoot up, and then there are regulations in most European countries that if there's speculation, you have to issue a statement sometimes within 24 hours. So it cuts the due diligence periods very short in take privates. And the second you approach a company, it's probably going to be public, and you have to make up your mind right away how serious you are before you even had a conversation. But under the surface, tremendous PE activity. You have still in Europe a huge amount of companies that were acquired by PE firms before 2008 that they're still trying to put back on the marketplace. They're still trying to IPO or sell. So you're going to see both ways. You're going to see the PE firms, of course, have grown a lot in the last 15 years and have a lot more capital, a lot bigger deals. There's tons of that going on. Almost every large European company we talk to and know is in constant conversation with PE firms about selling a business, a division, something. So yeah, PE activity amazing. VC less than the US, but maybe it'll grow a lot from some of these areas we spoke about.
Well, fantastic. This is very informative.